Hi, and welcome to the Modern Wall Street Show. Today we have an awesome guest. He is the best-selling author with one of his most recent books, The Road to Ruin. And rumor has it, he's releasing an updated version of one of my favorites later this year, Currency Wars. Let me introduce you to Jim Rickards. Hi, Jim. Nice to see you again.
Good to be with you, Voz, especially here in front of the New York Stock Exchange. Great location.
Absolutely, and what's really cool is in your books, the way you paint the markets doesn't really look like this, but rather you view it as a snow scene. Right. And while that looks really beautiful and peaceful with record highs, you're noticing some components that make this landscape very vulnerable.
Right, the snowflake metaphor, it's more than a metaphor, is for complexity theory. So we all have models of how we understand capital markets, how we understand the capital markets dynamics. Most of the standard models are obsolete and badly flawed. The ones the Fed uses, for example, is equilibrium models. They assume normally distributed risk, not true. They assume prices move smoothly and continuously, not true. Efficient markets, none of these things are true. Complexity theory, on the other hand, which is not new. I borrowed it from physics, but I'm one of the pioneers, not the only one, but one of the people bringing complexity theory into capital markets as a way of understanding how they work, getting very good results. But the snowflake avalanches, it's snowing, snow is building up. One snowflake comes along, it lands the wrong way, disturbs a few others, creates a chute, creates a slide. All of a sudden, the whole mountain rips loose. Who do you blame, the snowflake or the instability of the snowpack? So I would say, let's not blame the snowflake. If it wasn't one, it would be another. It's the instability of the system. So that's how I look at the financial system in terms of gross notional value derivatives, density of connectedness between the banks, percentage of assets owned by the five largest banks. There are a number of metrics you can use to basically gauge the size and scale of the snowfield. And from that, you can estimate the likelihood of a collapse and actually the extent of the collapse and how dangerous it will be.
Well, what market inefficiencies are you noticing that's going to create this collapse?
Well, there are more right now than usual. The number one is that, by the way, I should say some of these things are going to create some surprises and market moves. It might not create a collapse. So that's something that could happen tomorrow. It could happen 3 years from now. So that, in all likelihood, the thing that creates a collapse will be the thing that we don't see coming. Like I could give you a list, Voz, of a war with North Korea or a Fed interest rate shock, or Larry Fink was out this morning saying, the only thing that worries me is that the Fed basically commits a blunder, surprises the markets. Well, we might have one coming up in December, let's see. But it doesn't really matter. Again, look at the snowpack, look at the instability of the system. That's what I'm concerned about. But to your point, there are a number of things on the horizon right now that the markets are not pricing in, that I think traders and investors can take advantage of. The number one near term is the FOMC meeting in December. The market is giving an 80% probability that the Fed is going to raise rates. And we know that from the Chicago Mercantile Exchange, Fed Fund Futures. You can get an implied probability of a rate hike. And you say the market's around 80%. I'm giving it 20%. I'm basically saying the Fed will not raise rates in December based on very strong disinflation, which we see in the PC core year over year. It's been down or flat 9 months in a row. It's moved from 1.9% in December 2016, very close to the Fed's target of 2%. 1.9, 1.8, 1.6, 1.5, 1.4. Most recent reading is 1.3, moving very strongly away from the Fed's goal, not an environment in which the Fed wants to raise rates, plus the job loss in September. I understand it's hurricane related, but as in sports, a loss is a loss. So you got two things, declining job creation and disinflation that will cause the Fed to pause on rate hikes in December. You're starting to see this. Martin Wolf in the Financial Times, Larry Fink on CNBC, basically warning Janet Yellen, don't do this, and she won't. So there's a good opportunity there because as the market reprices from 80% to zero between now and December, you can capture that spread.
Yes, and we're going to see a significant reversal then because the dollar is so strong right now and gold is weak.
That's exactly right. So this all started around the middle of September, particularly got some emphasis September 30th when Janet Yellen did the last FOMC meeting press conference. So what happened then? The dollar got stronger, the euro came down, gold came down, interest rates went up, bonds came down. So you had all these immediate effects, all based on the assumption that the Fed is going to hike rates in December. As we get closer to December, and the market wakes up to the fact that the Fed is not going to hike rates, all these trades are going to reverse. You're going to see weaker dollars, stronger euro, stronger gold, lower interest rates and higher bond prices. So my favorite trade right now, and you still have a little bit of time. This is going to reverse very quickly. So I would say long gold, long euro. Get the euro at 117, watch it go to 120. Get gold at 1275, watch it go back over 1300. Get 10-year notes, watch yield to maturity drop from 2.3 to 2.1, which is a big capital gain, and short the dollar. Those are the trades I like through December. Now, by the time you get to year end, it might flip again based on a war with North Korea. This is what I mean about things not being priced.
Right. So is the Fed afraid of something? Are they going to get us in some mess?
The Fed is the greatest fear. The thing that keeps them up at night is deflation. We don't have deflation yet, but we have disinflation meaning we're moving away from the 2% target towards deflation. That's the Fed's biggest concern. See, it's important to understand, why is the Fed raising rates? The basic model is they're going to raise rates 4 times a year, every March, June, September, December, 25 basis points for the next couple of years through 2019 till they get to over 3%. Why are they doing that with the economy so weak? Well, the answer is, it's not that the economy is strong. The answer is they need to raise rates so they can lower them in the next recession. It takes about 300 basis points of rate cuts to get the U.S. out of a recession. How do you cut rates 300 basis points when you're only at 100 basis points? Well, you can't unless you raise them up to 300 basis points. So that's the basic mission. But there are 3 pause factors. There are 3 things that cause the Fed not to raise rates. The first one is a disorderly stock market decline, which we saw in August 2015 and again in January 2016. That's not happening now. Our friends inside the stocks are going up and up and up. So we're not seeing that disorderly decline. But the other 2 factors are disinflation, which we are seeing in a very strong form, as I already mentioned, and job creation below 75,000. Well, last month we lost 33,000 jobs, negative 33. So 2 of the 3 factors are in play in a strong way. Yellen's going to watch them, but they're not going to turn around. Might create some jobs in October, but not enough to really make her change her mind. And the disinflation I expect to continue. We'll have the September number at the end of October, and I expect that to continue to remain weak. So all the signs are in place for no rate hike in December.
What does this mean for the almighty dollar being the world's lead reserve currency? I mean, what's the ETA on that ticking time bomb and the outcome?
Well, ticking time bomb is a good description. So what we're talking about right now with the Fed easing in December relative to expectations by not hiking rates, that's going to change the dollar-euro cross rate and the dollar-gold cross rate in different ways. That's not the end of the dollar. That's a much bigger question. But when we're talking about running the dollar off the road as the benchmark global reserve currency, the signs of that are everywhere. So Russia tripling its gold reserves in the last 10 years. China tripling its gold reserves in the last 10 years. Are the Russians and the Chinese stupid, or do they see something we don't? Well, I suggest the latter. They're not stupid. They understand that they need to acquire gold so they can be robust to this decline of confidence in the dollar. Also get some out from under U.S. sanctions. We can move gold around on airplanes. We don't have to rely on the dollar payment system, which the U.S. controls. But in addition to that, the BRICS currently have just under 15% of the vote in the IMF. It takes an 85% vote to do something. So that means if you have 16%, or actually more than 15%, you can block it. If you have a liquidity crisis like 2008, and the central banks have not normalized their balance sheet, and the world turns to the IMF to print trillions of SDRs to reliquefy the world, the BRICS, once they get over 15%, and they're not there yet, can in effect veto that, unless there's a quid pro quo, which means the dollar is no longer the benchmark reserve currency. However, they now have a hidden ally, or a proxy, if you will, which is, I'm calling it BRICS plus V, V for Venezuela. So in other words, Venezuela is such a basket case. They've come under the wing of China. It's almost as if China has a proxy for Venezuela's votes in the IMF. Venezuela has agreed to sell oil for yuan. That's another step away from the petrodollar deal. But when you combine Venezuela with the BRICS, BRICS plus V can block any significant action in the IMF. So they're going to say, you want SDRs? That's fine with us, but this means we're no longer going to privilege the dollar.
Wow, so we're going to be using IMF coins now?
Christine Lagarde actually talked about that, and this is one of the reasons I'm not a fan of Bitcoin. The IMF is talking about a digitized SDR. I mean, look, it's already digitized. There are no paper SDRs. We don't have them in our pockets. Banks don't keep them in vaults. So the SDR is already a digitized cryptocurrency. What it does not have is what's called a distributed ledger. You know, the new name for blockchain, distributed ledger technology, DLT. That's a little broader, more forward-leaning than the blockchain, which is just one form of DLT. But Christine Lagarde is talking about putting a digitized, encrypted SDR on a DLT, on a distributed ledger using technology. And basically that would be a platform for the SDR's world money. So now you can move it around cheaply. You can bypass the dollar payment system. You're not relying on SWIFT. You're not relying on U.S. Mother May I. You know, she's got to be careful about that because the U.S. still has a big voice in the IMF. But it's not clear that the global elites, people, I'm not talking about Secretary Mnuchin, I'm talking about people like David Lipton, who's the first deputy managing director of the IMF. He's a Bob Rubin protege or a Bob Rubin plant. These people don't disfavor the SDR. They think it's a good thing. So there are all these straws in the wind. You just have to connect the dots.
Wow. Well, if that's the case, I got to ask you this, Jim. Do you believe that there is this plunge protection team, the PPT, that jumps into the market to defend it during critical points like North Korea testing ballistic missiles or the Vegas shootings or hurricanes?
Well, look, I don't believe in conspiracy theories. I think the information actually is out there. It's just a little bit hard to find at times. As far as North Korean missiles, it's interesting because you go back a few months, North Korea would loft a missile and the stock market would go down maybe 1%, not like 2 or 5%, but down 1% or whatever. Then the market would hold its breath and look around a little bit and say, oh, it's okay, and it would go back. Then there'd be another missile and it would go down another 1%, and then it would go back again. And all of a sudden the market said, well, what's the point of going down if we're just going to go back? So they have normalized missile launches, which actually should be very, I'll say frightening, very threatening in terms of being on the path to war and discounting the war. But the market's not discounting a war. They're now not even paying attention to missile launches. What may happen in the next 10 days, we're past October 10th. There's a window from October 10th to about October 20th. My expectation, high expectation, I give this 80% plus probability, is North Korea will test another ICBM in this window. Now, I just said the markets have kind of normalized that. They won't pay attention. Here's the difference. The U.S. may shoot this one down. The President just met in the Situation Room. There's some talk about this. We call it rumored intelligence. I don't want to put a stake in the ground. I'm not as categorical about the shoot down as I am about the launch. But it would not surprise me, and I would share with our viewers, that the U.S. may shoot this one down, and everyone will say, and that'll get the market's attention. Then you can see a drawdown then. And everyone will say that's an act of war. They forget that the war's not over. The Korean War, 1950 to 1953, is not over. There was never a peace treaty. They agreed to an armistice, which just means we stop shooting, but they're still technically in a state of war. So to shoot down the North Korean missile with UN sanction, which we have, you can say it's an act of war, but the war's not over.
Well, Jim, you are so on top with predicting things. Just finishing up, can you give me your top 3 predictions so we can do a timestamp on it?
Okay. The Fed will not raise rates at the December FOMC meeting. We will have a shooting war with North Korea by, my expectation is the spring, summer of 2018. But if it's any later than that, it's game over. North Korea will have what they need then, and we won't do anything. But I would expect it then. And I look for gold to be significantly stronger by year end. Okay.
And Fed Chair?
Kevin Warsh. So we already know that, yeah.
All right, so not a Goldman Sachs member. That's really interesting.
He's a Morgan Stanley guy, but he has a lot of other things, a lawyer too, which I like.
That's true. Well, Jim, I've always said your books are like the Da Vinci Code of economics. Where can our viewers get more of you?
Well, I mentioned the books, thank you. The Road to Ruin is my most recent book, and then also last year I had The New Case for Gold. I'm active on Twitter at James G. Rickards, and I have a new company I started. We're working with a great team, a CEO and IBM Technology, to actually build out bigger predictive analytics systems using the methods we're talking about. It's called Miraglim, so MERAGLIM. Go to miraglim.com to learn more.
Very cool. Well, that's up my alley. Jim, thank you so much for taking the time to meet with me and inspiring us to think.
Thank you, Boz.